Okay, let's get started, shall we? So, um, last week we started by looking at the mechanism by which the market moves. This idea that it moves, not because there are more buyers than sellers or more sellers than buyers, um, market sellers or market buyers, that is, but because of the ratio of market to limit orders at any given price, right? In other words, price pushes to the less liquid side of the market. So the question now is, well, which side of the market is less liquid? Um, how do we know where these imbalances are going to occur? Where is the liquidity resting? And how do we know where there's an absence of liquidity? And then how can we begin to derive trades from that knowledge? And so we're going to start this time by looking at candlestick charts primarily. Now that we understand something about what's actually going on inside the candles. So over the next couple of weeks, we're going to be putting last week's work into kind of price action context, which will hopefully allow you to start taking trades based on this new understanding. Although, of course, I wouldn't advise taking trades, based on what I'm talking about here immediately. It needs to be thoroughly back tested, of course. Anyway, one kind of observation which is common across almost all trading styles is that price shifts between different states. Okay, so some people call it trending, ranging, balance, imbalance, depending on what kind of school of thought you've arrived at trading from: impulse or consolidation, accumulation, distribution, markup, markdown. The list goes on, and you get this is ICT, the inner circle traders, laughable market maker sell model. These are just some very basic schematics based on a guy called Wyckoff's work almost 100 years ago. Let me just meet whoever's joined. Right. So whatever you want to call it, base, cluster, block, range, price spend sometime in a low volatility state, right? Low volatility state of a relative kind of equilibrium or balance, and it spends some time putting in big candles as your trending or impulse kind of component. Like these, there's usually is an absence of bids or offers, kind of spreads price, and it starts reaching for liquidity. And price will move until it finds that liquidity, or until let's say we're up in here, will move until it finds that liquidity, or until buyers simply dry up and the imbalance begins to shift, and price starts moving in the other direction. So this really is a kind of basic structure we're going to be looking at today. Barak, so why is liquidity resting on these said zones in particular? I'll come on to that. Okay. So this is what you get, a swing in price, and this is a gold chart. I think it's 15-minute hourly chart, something like that. But it's from a while back, and it's just a kind of very nice example of a swing in price. Okay, price goes up and price goes down. Now, I'll take you through some of the ways in which we can kind of gauge or have some expectations about the extent of a move like this in more detail in the webinar on scale and managing expectations when we come on to that. But for now, I thought we'd just start by focusing on the structure of a swing like this and what you should be looking for when you see a move like this occurring. And as I said last week, you'll find price swings like this on every time frame, and they'll always look different. But the behavior of price is generally quite consistent. Okay, no matter what time frame you're on. Right. So when price is kind of consolidating like this, there's relative stability or equilibrium. We consider price to be in balance. So the buying is not enough to overwhelm the sell side liquidity sitting in here, and the selling's not enough to break down through the buy side liquidity, which is resting in these areas. And I'll explain why and in which kind of areas it tends to cluster in later on and next week as well. But when one side is, I guess, kind of exhausted or weak, or a large order or set of orders comes into the market, in this case, an influx of buyers over here, right? Then price will move out of balance. So this move here, okay, is characterized by an imbalance, and that imbalance is exacerbated by the liquidity dynamics we talked about last week, some of which are kind of triggered or initiated as a result of market structure. Okay, let's clear this up a little bit. This being market structure, okay. Quite clear, kind of relatively equal highs. And over time, these range highs become points of reference for other traders who place their stops just up here, or they use a break of these highs as a kind of trigger for action. So they'll either puke their short positions, or they'll be buying the breakout. So a break of significant kind of psychological areas in the market act as a trigger for action. And obviously what you get then is an increase in order flow. So I wanted to show you the kind of macro breakout in gold, which occurred a couple of months ago, because it's a beautiful example of what tends to happen on the break of significant highs and lows. So just some perspective first on the weekly chart here, and you can see that gold has been kind of trapped in this broad range for, I think, about 7 years before it finally broke out in here. I think it was in June. And these highs, which I've highlighted with the dotted lines, are what I want you to pay attention to, because although they hadn't been touched in a couple of years, you can see that even on this time frame, they still act as triggers for an increase in order flow. And what I've got here is a 1 minute chart of the day on which price broke those highs, delineated, there by those dotted lines, and you can see that you get massive volatility the instant those highs get broken. As they get breached, stops get triggered, and breakout traders rush in to buy this up. And of course, nobody wants to stand in the way of a move like that. So market makers, who are of course well aware of when price starts moving quickly, or the areas or the kind of areas where big stops are going to be resting, they're aware of that, and so they'll withdraw liquidity from the market. They widen their spreads. So I explained last week, because the last thing they want is to be providing sell side liquidity in an area like that, just above old highs, where there's very likely going to be a large influx of order flow, which will take them offside very quickly. Okay, so I'm just quickly kind of recapping what we went over last week, and just to make the point that make no mistake that these major highs and lows are really significant kind of psychological reference points around which traders make decisions. All right, I hope that's quite clear. I'm also going to show you what a move like that looks like on the footprint chart now, just to give you another perspective. And this is Bitcoin, and the level we're looking at is this 10K high last year. Okay, it's this candle here, the break of that level, which I'm going to show you on the footprint chart. And let's see, excuse me. Is that playing? Yeah. Okay. So what I've done is just recorded the footprint as the level broke, so you can see in kind of real time how the liquidity dynamics shift or change when price breaks that high. And I've just marked out the actual high at 9970 or whatever it was, and then the kind of psychological 10K level just above that. So I'll play this now, and just note first, how price is trading on the left there, relatively slow, relatively kind of efficient, and then watch as price breaches these levels. And note, I've marked out the actual high there at 9970, but often when you've got a big level like 10,000, traders will tuck their stops behind that for whatever reason. And I've got quite a good paper on that if anyone's interested in reading that, just explaining why stops tend to cluster beyond round numbers and take profit orders tend to accumulate just below or before round numbers. Okay, so that's why I've got the 10K level marked out, because anyone with their stop above that 9970 level will likely have just shifted it up a bit to keep it out of harm's way above 10K. So note when the imbalance begins, it's actually on a break of those. Get the strong tool up. These local highs, okay, what you get is a quick flurry of buying. See that? Quick flurry of buying. More than likely stops getting triggered there before price starts trading up at the high, and those remaining sell limits get bought up, and you start to see some aggression in here. But it's when 10K breaks that you get that really strong imbalance, that shift in liquidity. So you can already see some zeros in here on the bid as stops start coming out. And yeah, just pay attention to when 10K finally breaks, and you'll see kind of in real time everyone's stopping out, and you know everyone's stopping out because you've got this string of zeros on the bid, and as a result, price very quickly trades to a really wide range of prices. See the aggressive buying at 10K there on the right. And there's your stop out. Okay. Anyway, that's just to demonstrate again the kind of order flow we would expect on a break of really significant levels. So it's a highly inefficient move. Is that clear to everyone? Yeah, great. Couple people just joined, I think. Hang on. Okay. So back to this swinging gold. So you get these periods of balance and imbalance, and what happens is price moves up, it's inevitably going to hit some pockets of sell side liquidity, okay, as it moves, and it will stall, and it will find very brief periods of balance. Even in here, let's hit a very small pocket of liquidity. On the lower time frames, that would look something like that, right? Very small period of balance in here again, for a brief time before either reversing or moving on higher. And remember, the premise from last week was that when price moves like this, right, these large range candles, okay, illiquid moves, it tends to overshoot, and when it overshoots, it leaves a vacuum of bids in its wake. So a candle like this one here, or a series of candles, okay, this kind of pause in price or consolidation, when it comes after a thin or illiquid move like this, that tells us a lot, okay? It tells us that although, just clear this up a bit, although prices hit some sell side liquidity up here, we know that because it's stalling, right? There are also bids willing to chase. Because if they weren't, if bids hadn't come in here to support price, it would have very quickly drawn right back into this base here, because we know that this is a thin or an illiquid move, and it doesn't take much selling for that to completely retrace. Okay, so we know that bids have come in here just from a candlestick chart. So these brief periods of consolidation tell us that buyers have been willing to step in to chase prices higher. And it's this kind of structure we're going to be focusing on today. Right. What have we got here? Okay, so I've got another video to show you, and in the video I'll show you this kind of section of price action on the very low time frames. This is already, I think, a 1 minute chart, but I'll show you it on a tick chart. And in the video, I think we start around here or here, okay, down at the bottom of this illiquid move, and we finish up around here, okay. So I just want to show you what happens when price moves up, kind of thin or illiquid like that, and you get this pause in price. All right. So it's just in here. That's what we're interested in. This candle, actually, it's just a wick on this time frame, but it's this area here where we're interested in. Okay, similar to that area I pointed out in the gold chart I just showed you. Okay, there's a void in here, fast move, and then this is the first place we know buyers stepped in to support price after the kind of bulk of the move. Right, so I'll just play this for you. Okay, this is a heat map, and all that it is, as I explained last week, I think when I showed you a chart from Bookmap, it's just a visual representation of the order book. In this case, the more dense the liquidity is at a particular price, the more intense the coloring. So I'm colorblind actually, but I think this is kind of blue, isn't it? Those are sell limits, and the cream or white is buy limits. So you can see you've got some liquidity here, and then up in here is a little more dense, and you can see this cream here is bids supporting price as it moves up. So what happens? Price starts pushing up, and you can see bids pushing up with price. That cream representing buy limits there. Okay, liquidity gets pulled or consumed, and then what you get is a very fast or illiquid move there. You see that? There's nothing on the sell side here. Okay, price moves through it very quickly, and again until it hits this liquidity up in here. Okay, and you can see down here around 8316, 8312. This is the first kind of price or range of prices at which bids are willing to step in. Okay, and you see that's where price finds support. So it's the bottom of this candle here, which is important. These kind of nuggets or pauses in price, which will often just show up as single candles in the chart, they represent pockets of liquidity to me. You can see here, okay, the first price at which bids were willing to step in and support price to chase prices higher after a thin or illiquid move like that. And that tells you something about the aggressiveness of those buy orders, because of course underneath this area you've got a gap. So when you step in there, you take on gap risk, right? If price blasts through your orders, you're going to be caught offside very quickly. Okay. Anyway, I hope this demonstrates the way in which liquidity is kind of drawn up with the market. And you can see this was the area, this was the formation of this wick here is what we just watched. Okay, this being the area where those bids came in to support price, and that's what I call a flag limit. Okay, you can see this candle or wick there is the structure which held up price, held up this kind of flag, this consolidation. And when that area broke here, right, that's when you got the retrace. This whole move gets filled in. Gold again. So the idea is that as price moves up, right, there are buyers chasing. Okay, so liquidity, buyers which came in down here, their bids will move up with price, or at least some of them. Okay. And the areas at which the candlestick chart appears to have found support represent those pockets of liquidity. Okay. In this case, areas where there are buyers, where liquidity has been kind of drawn up with the market, and as it moves higher, some of these bids will be unwilling to chase price higher, and so although some of them will chase all the way up here, and even up in here, there will still be some kind of residual buyers waiting in these areas. Does that make sense? Let's say you've got 100 buyers in here. Let's say 50 move up to here. 30 of those move up to here. 10 move up to there, and then you've got, some of them get left behind. Right, is the point I want to make. You've got, residual kind of liquidity sitting in these areas. And what happens eventually, price will run into some significant sell-side liquidity up in here. And by that point, buyers are relatively weak. Okay, not all of them have been willing to chase. Buyers are relatively weak up here. Okay, and so the sell-side liquidity is clearly significant enough to stop price from carrying on up. All buyers have simply dried up, and so price gets kind of trapped in between whatever it was up in here, stopping price from moving higher, and this last pocket of buy side liquidity. Okay, gets trapped in between those two areas, and it flags out. Okay, so this is the flag limit, what limits the flag from going lower, and this is the flag area. It's just a consolidation. And it's much like down here, it's a flag. Somewhere in here, there's some liquidity which is holding down price, and that's what's important for me. After a run like this, I'm thinking, where is the area which is holding up price? Quite clearly, this structure here, this structure here on the bottom, and when that breaks, you get the run up, and when this breaks, you get the retrace. But I'm going to go into this in a bit more detail. Okay. And people will slap all kinds of patterns on structures like this. But in essence, it's just an area of consolidation, right? Which will last as long as its limits contain enough liquidity to satisfy the buyers and sellers in that area. And if one side or the other starts to fail, if the liquidity there starts to dry up, price will break out. Barak is asking, why would buyers leave their unfilled positions there after such big price run, i.e. at the low in the gold chart? Down here, you mean? It could be, it's all kinds of reasons. That's the price at which people want to buy. Often it's the case that a thin move like this, or a run in price, isn't necessarily like indicative of any kind of fundamental driver, right? As I explained last week, the market's not in a constant state of sentiment, so this run up could just be the product of the kind of order flow dynamics I explained last week, right? It's not this when gold is up here, it doesn't really reflect necessarily the value of gold, and so why would buyers want to chase it all the way up here if it's very likely going to revert to somewhere down here, where the volume is what some people might consider the more kind of fundamental value. That makes sense. But most of the trading occurs where the volume is, where you get these consolidations, and when it runs out, very often it will gravitate back towards these areas. That's where people are interested in trading. So, to answer your question, you never really know the intentions of other traders. Who knows why they want to buy at these prices, and who knows why other traders chased price. It's just a behavior or a dynamic which can be observed and can be traded. Okay. Ben's asking, did gold go up after this down move? Yeah, I believe it did. This was from a while back. To answer your question, Barak, afraid it's a little unsatisfactory, but we just don't have, we don't have all the answers. So, the structure up at the top here, will last as long as this area in here and this, whatever the structure is somewhere on the left, which is keeping this down. It will last as long as those areas contain enough liquidity to satisfy the buyers and sellers in this area, or until a big buyer or seller steps in, much like they did at the lows here, and you get that shift in market structure. You might have seen these schematics before. It's Wyckoff again. But you can see that he observed the same kind of structure or behavior almost 100 years ago. Here's your flag limit, right? This is your flag consolidation. This flag limit he called preliminary support. The structure which holds price down after the selling climax until price is finished flagging out, and it finally breaks through up in here, which he called the sign of strength. So you've got the same in reverse here, just another schematic basically showing the same thing, but they're really useful structures to have kind of ingrained in your memory, because they play out again and again on every time frame. And our kind of premise here for a potential trade is that this leg is weak, okay? It's an illiquid move, so if price starts moving into this area, it's likely going to go all the way through, okay? As a result of the way in which it moved up, it's illiquid, and it's therefore vulnerable to a retrace if or when the bids in here dry up or sellers step in over here, okay, and overwhelm whatever buyers remain in that flag limit. And some people might look at the structure like this and call it a bull flag or some other continuation pattern, and I'll often take continuation trades off a structure like this flag limit area. It all depends on context, because it's essentially support, and I'll come onto that in the coming weeks. But for now, I just want to focus on this variation, because the reality is that the higher price gets and the faster it gets there, the weaker it is, and the more likely it will just come crashing back down again. In this sense, as I explained last week, it's often when price looks the most bullish that it's actually at its most bearish. Okay. Look at Bitcoin up at 13K. Okay. And it's misunderstanding the liquidity dynamics responsible for a move like that. Which will sap your confidence, right? You'll lack the confidence to short, or what you'll do is end up buying the top. So having a really clear understanding of what's behind this kind of price movement, it will eliminate the need for indicators or for mechanical, rule-based systems based on patterns, which are both, of course, just derivatives of the dynamics which manifest as price action. So this is quite a good example. Something like some people might call this kind of a ascending triangle type structure. Typically bullish pattern, but it's just worthless without context. you have to know, like, is there liquidity resting above the highs there? What's holding this structure up? Has it been consumed or partly consumed? There's so many variables which I'll try and explain in the coming weeks, and they're all important. But the point I'm trying to make is that you can't rely on patterns like this without an understanding of the liquidity dynamics in and around price. And if you don't have the ability to distinguish between a pattern like this, or structure like this occurring one time and the next, then you'll find yourself getting confused and frustrated, and it's those emotions which will snowball and have you taking trades motivated by revenge or other facets of the mind which end up taking a kind of heavy toll on your expectancy. So rather than looking for recurring patterns which which are often useless without this context, what I think is the way forward is to actually kind of read price. So where is liquidity? Has it been consumed? If so, where can I get in? Where is price heading? And how do I expect it to move? And if you've got an answer to all of those questions, then you can find really accurate entries and get in with tight stops. And you also know how price should move. So if it doesn't do what you expect, you can usually get out quickly before taking the full R loss. Anyway, so when I see a structure like this one here, I'm paying really close attention to this area here. Okay, the last area of kind of known liquidity where we know buyers stepped in, because that's the structure which is currently holding up price. And when price starts consuming the liquidity in here, right, each time it dips into this area, that's people market selling into the bids which are resting here. Okay, so each time it dips into this area, it's consuming liquidity. And when it does that and it's failing to push higher, okay, looks particularly weak kind of towards the end here. In other words, when it's kind of washing out the liquidity in this flag limit, then it's time to start looking for shorts. And this is one of the more reliable signs that the tide is about to turn, as it were, and price is about to start heading down to seek out buy side liquidity to satisfy the demand of the sellers who've come in up here. And just like buyers did down here, we'll start to chase price as it moves down. Okay. And I think I've got an example of a trade I took on cable not long back, just to demonstrate what I'm trying to get across. And note this area in here quite clearly, the structure which is holding up this flag. Okay, comes into it once, comes into it twice, comes all the way to the extreme of it. So at this point, I'm thinking, okay, there's very little liquidity left in this structure. Breaks it here and taps into this next area of liquidity. Okay, so once it's broken this area, I'm looking for shorts on a retrace, and it was this area up in here which I was interested in. You can't see it on this time frame, but there was a small pocket of liquidity in here, which I took the short at with a stop above. Knowing that price would very likely move through this area, okay, because the structure which was supporting price has been consumed. Sellers are starting to kind of take control, to overwhelm buyers. I don't expect much in this area. Okay, it's quite a fast move up. So yeah, that's what I'm looking for. And we've got different levels of experience and understanding in Hill, but I'll quickly go over a common misconception in just in case any of you are still under that particular illusion, and that is that the more the level is tested, the stronger it gets, and it certainly appears that way. I mean, a level like this, we can for sure say is support, because we can see that price has reacted there 1, 2, 3, 4 times. But what happens each time this area gets tagged, the buy side liquidity resting in that flag limit is getting consumed. So if you're planning on taking continuation trades off a structure like this, the highest probability trade is to trade the first or maybe the second time back, okay? Because the level is kind of fresh then, or untested. There are still buys in there. That's why we like to look for clean levels, because a messy level, right, like this is now, indicates to me that the liquidity in this area and this flag limit has already been at least partly consumed, and we know when it breaks through that it's been entirely consumed by all this kind of fucking about. One thing I don't understand, by the way, when marking out charts, is why people don't consider the wicks important, right? This wick here, for example, that's it's broken through this area and is eating into the liquidity which is resting in this pocket here. So it's relevant, it tells us that the liquidity in this flag limit has been consumed. Okay, so pay attention to the wicks. They're not meaningless. I've got a few more examples of this kind of structure, which I'll show you now, just so that you're a little more familiar with what you should be looking for, because of course this it comes in all different shapes and sizes. I think this is USD JPY. This here is excuse me. Right, this is the structure which is holding up price. Okay, first major kind of pause or consolidation after this didn't move up, and price moves to the extreme of that level twice, and then it consumes it there. It engulfs it on the third time. I took a trade up here on this one after this kind of false break of that high into a really serious level, and this already having been tested twice. Okay, by the way, it's significant that price goes to the extreme of this level. Okay, I expected it to move through here and to fill in this gap, and eventually this gap here. Barak's asking, how did you know it wasn't just a continuation? At which point? I mean, well, at the point I took the trade, the premise was this. Okay, I mean, the answer is you never know whether or not it's going to be a continuation or a reversal structure, but your job is to take, put the probabilities in your favor and take trades with high risk reward. which will make up for those times when you're wrong. Okay, but the idea here is that this is the structure which is supporting price. So there are bids in here. Okay, this candle here comes all the way to the extreme, and then again. Okay, so I really don't anticipate there to be any more support in this area. It just so happened that there was a really significant level resting just above this high at the time. So for me, this offered really tight kind of risk reward, right? You're wrong up here. If it breaches this level, which I expect it to do, it's likely going to go to here and potentially even here. Okay. Don't know. You're making an assessment of how much liquidity you expect to be left in this area, and then looking for some significant area of sell side liquidity to take a short at. But yeah, the answer is, this may well have just continued on up, and that's where risk reward comes in. Okay, because you're not always going to be right. Is it too early to start asking about your targets? Yeah, I'll come on to it next week. Okay. I'll start talking a little bit about where I expect price to move, but then we'll talk a lot more about targets in the webinar on scale and time frame, because that's what will determine a lot of my targets. Okay. So yeah, I won't go into it. I won't go into it too much just now, if that's okay with you. Okay, what have we got here? Okay, this is gold again. What have we got? Okay, it's an interesting example of how price is fractal, behaves the same on every time frame. So note here, flag limit and price flags out on top of that. But then on the higher time frame, right, there's a bigger structure here, which this is kind of sitting within. This is your flag limit. Note price breaches it there. That's significant. Okay. At that point, I'm thinking, okay, there's no more bids in here. And what have you got below that? Well, there's fuck all there. Okay, it's an illiquid move. So that's when I'm looking for shorts. I think in this case, I actually waited until somewhere down here. But, just to demonstrate the idea again, bids in here have been consumed. Look for somewhere where you'd expect liquidity and short it, anticipating price to break not only this area but to run through this thin or illiquid move. This is Bitcoin. Just same thing but in reverse, because I know a lot of the examples have been kind of bearish structures, but this is just the same principle but on the bottom. Flag limit here, the structure which is holding down this flag comes into it once, comes deeper into the area, breaks it here, and then there's nothing in this area here, and as a result, price spends no time moving through it. Bitcoin top this year. Similar to the gold fractal I showed you, you've got actually an area in here which held this kind of flag up, right? That gets breached, and then it's this area in here around 9K, which you can see is quite clearly holding the broader structure up. Once, twice. Don't expect there to be much down in there. Price very quickly retraces this thin or illiquid leg and price. Okay, and it moves until it hits volume. And then I think I've got what is this? I think it might be a tick chart or anyway, very low time frame. Yeah, it's a 10 tick chart, and ticks being trades. So each candle is 10 trades. So these are tiny time frames. And you can see even on this level, the same dynamic plays out. Thin or liquid move is your flag limit. Bids in here, price flags out until it breaks through this area, and then it retraces this thin or liquid move. So that's about it for today. And now that I've given you a kind of brief introduction to that, what I call the flag limit, and why it's a really important kind of structure to identify when looking at a swing in price like this, it would be really good if you could go away and find loads of examples of this on your charts. So whatever it is you trade, just go and find a variety of examples of this structure. Take a screenshot and just stick them in a folder. And just see what you notice. Write down any observations, pardon me, any observations about price, things which look familiar to you based on what I've covered today, and even stuff, anything which doesn't align with what I've been saying here. Take a screenshot, make a note, stick them in a folder. And that way you've got a library of examples, and then anything you've got questions about, we can go over them together when we meet one-on-one. And it's by building that kind of visual library that you'll start to ingrain these structures in your mind. And it's when you do that you're able to recognize them quickly. And you'll start to notice the different kind of variations, right? So next week we'll go into a lot more detail about entries, okay, how and where to get in, and some more kind of practical examples of how I mark out charts as a swing like that is developing, and the various different points at which you can look for trades, okay, as something like that develops. And we'll talk about how to actually get into taking trades based on this kind of framework. Yeah, that's it. Is that okay for everyone? Any questions? I hope that was clear enough. No problem. What I'll do is send out the recording of this later on today. In fact, I'll just put it in the screencast folder, and you'll be able to access it there. And a need to meet form, so that if any of you want to meet next week, Monday or Friday, you can book a time. And I think I'm meeting with a few of you this afternoon, so I'll speak to you then. But in the meantime, have a good weekend.